Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. As I mentioned, last week was packed with economic data. Tuesday we got flash PMI, which came out a bit better than expected, which was nice to see. Wednesday, the Fed meeting minutes came out, which is what I was really waiting for, and most of the attention was put on an interesting statement in those notes. The statement was that, quote, almost all Fed members supported the rate hike. Almost all? Not definitively all? That might sound like I'm splitting hairs, but when it comes to public releases like this, the word selection matters and is purposeful. So when things like this come out, we can look at that piece and establish that someone or someones are starting to feel that the end could be near. However, there is a problem. The problem is that all the data the Fed references as justification for their decisions is contradicting the idea that their rate hikes are over. The market seemed to have looked past the notes and are wagering that there will be another rate hike in March because we're nowhere near the Fed desired inflation target. And in their own words, the labor market, quote, remained very tight, contributing to continuing upward pressures on wages and prices. Also known as the wage price spiral. Prices go up and causes wages to go up, and while wages go up, that causes prices to go up. Thursday, we got preliminary GDP reading that came in lower than expected, which does make us wonder where the easing is coming from, because the prior reading had a heavy dose of government spending packed into it. So are we to assume the same for this most recent reading that's lower? If that is the case, then slowing in both the public sector and private sectors is slowing as it should be. We got unemployment on Thursday, which was better than expected, putting more pressure on the Fed. They will need to cause more pain in the labor market to force less spending in the economy to stand any chance at returning to a 2% inflation target. Friday, we got core PCE, which was another whammy to the Fed. It was expected to come in at 0.4% and came in at 0.6. Now that seems like a small difference, but it's not. 0.6 is 0.2 higher than 0.4, but 0.2 is half of 0.4, which means that a 0.6 print is a 50% higher reading than was projected. And remember, this is still a positive number with a plus sign in front of it, meaning that we're still overall experiencing higher prices compared to the previous reading. Now that brings us to this week, which is going to be a little bit slow. Monday will bring us pending home sales with a pretty low forecast, kind of par for the course right now when it comes to readings related to mortgage and real estate. On this show and the podcast, we've been talking about inventory shortages, which are helping keep home prices relatively high still, and with mortgage rates still elevated too, pending home sales have really become a trouble spot. Tuesday, we'll get consumer confidence, which is going to be really interesting because sometimes the data we talk about contradicts the elevated optimism among consumers, which can distort or even cover up some of the inner workings of the overall economy. We'll see how confident the consumer really is this week. Wednesday, we get ISM manufacturing PMI, which has been in contraction for months, and we're expecting that to still be the case this week. Thursday, unemployment will roll out, and Friday, the ISM services PMI comes out, which had a surprising optimistic reading last month. So it's up for grabs this week, whether or not it will become more good news or swing back into the bad news category. So what's all this mean for mortgage rates, Andy? Mortgage rates have come under heavy pressure recently, with the data supporting the assumption that the Fed will have to continue raising rates until they achieve optimal pain in their plan. Until then, there is no reason for the market to assume that we will see rates returning back to historic lows or even going in that direction for long periods of time. It's certainly clear that the mortgage market is going to continue struggling without the Fed's involvement in buying mortgage-backed securities. As that is the case, it puts additional pressure on mortgage-backed security investors to hold the line and build a tough stomach over the course of the upcoming months that the Fed has to continue raising hikes and make policy changes. Rates will ebb and flow in response to money coming into the mortgage-backed security market or going out of the mortgage-backed security market. As we've been teaching you, the more money that comes in, the lower the rates will go, and vice versa. Money that leaves the market creates more scarcity, which causes rates to rise. We're also at the point in the cycle where we're getting closer and closer to the next Fed meeting, and everyone's antenna are looking up and listening for any cues that could signal change that impacts the rate market directly. So if you are not subscribed to this channel, be sure to subscribe, turn on notifications so that you see this show every single week right when it posts. And if you have not checked out our other weekly show, the Mortgage Heroes Podcast, you can find that here on YouTube, but also on Apple Podcasts and Google Podcast. Or you can look for the links to the show on our Facebook and Instagram pages. Remember to share this video with someone you care about so they can win in mortgage and real estate in 2023. Thanks again for watching, and we'll see you again next week.